Welcome to the Daily Block, the top events from the past day in crypto and why they matter. If you trade the squiggles, pay attention. Today's menu has government drama, giant stablecoin prints, and on-chain perp chaos. Let's dive. Bitcoin rally accelerates as U.S. government shutdown deepens. Bitcoin popped above $118,000 after U.S. political gridlock and softer ADP jobs data pushed markets toward rate cut expectations. Spot BTC ETFs soaked up hundreds of millions of dollars in inflows, which helped fund the move and turned sentiment toward Bitcoin as a macro hedge. Momentum in Bitcoin spilled into majors and altcoins. It's a classic squeeze plus flow day, where price action feeds on itself. Why it matters for crypto investing: big macro shocks. Plus, concentrated ETF flows create quick, tradable volatility, perfect for breakout plays, mean reversion scalps, and the liquidation squeezes short-term traders hunt for. Riskless counterpoint: if the shutdown resolves or the Fed leans hawkish, the macro narrative can flip fast and blow out long positions. ETF inflows can be front-loaded and reverse if risk sentiment hardens. Next up, Tether mints $2 billion USDT on Ethereum. Fresh liquidity. Tether minted a single $2 billion tranche of USDT on Ethereum, one of the largest stablecoin prints in months. That amount of freshly issued stablecoin is like an institutional bazooka of dry powder. It often precedes large spot buys, DEX sex activity, or big DeFi deployments and arbitrage. Where that mint lands, exchange hot wallets versus cold treasury addresses, will give you the clearest hint of intent. Why it matters for crypto investing: a sudden $2 billion increase in stablecoin supply is immediate firepower that can fuel rapid rallies or concentrated dumps. Watching order books, funding rates, and destination wallets gives a real-time edge. Risk counterpoint: mints aren't always buys. Tether can mint for redemptions, internal rebalancing, or OTC settlements, so the mint alone isn't proof of imminent Bitcoin buying. Also on-chain, Perpetual DEX monthly volume tops $1 trillion for the first time. On-chain data shows Perpetual decentralized exchanges cleared over $1 trillion in monthly trading, led by Aster at $494 billion and Hyperliquid at $281 billion. Protocol incentive engineering, reward pools, fee rebates, and yield sharing, plus L2 throughput gains are driving traders to on-chain levered venues in droves. The volume spike signals derivatives liquidity is migrating out of centralized exchanges and onto programmable rails. Why it matters for crypto investing: if leverage and liquidation dynamics move on-chain, the epicenters of short squeezes and gamma squeezes shift as well. So you should start watching on-chain order flow, funding rates, and liquidator activity in addition to CX order books. Risk counterpoint: on-chain vol is noisy and can be amplified by protocol incentives or wash trading. Smart monitoring and validation are required to separate real capital from engineered volume. Moving on. PeckShield. September crypto hacks and scams totaled $127.1 million. Security firm. PeckShield tallied about $127.1 million. Lost to hacks and phishing in September, down from August, but still sizable. Notable incidents included UXLink at $44 million and a Swissborg integration drain at $41.5 million, spanning multi-sig exploits, API manipulation, and phishing vectors. These attacks hit retail and institutional coffers and tend to create sudden, painful on-chain sell pressure. Why it matters for crypto investing: exploits generate immediate supply hitting the market, potential delist risk, and exchange flow spikes that can cascade into forced liquidations. So tighten position sizing and watch exploiter addresses for dump signals. Risk counterpoint: some stolen funds are traced and frozen, and not all hacks result in instant market dumps. Sometimes the exploiters sit on proceeds, which delays price impact. Also hot right now: stablecoin duopoly losing share, yield entrance, and tether diversification. USDT and USDC combined market share has slipped to roughly 83 to 86% from a 91% peak, as yield-focused stablecoins like Athena USDE, USDS, and PUIUSD, plus bank institutional entrants, gain traction. Tether is also diversifying its reserve palette, quietly buying more Bitcoin and adding non-cash assets like gold and land claims to its filings. The stablecoin landscape is fragmenting as yield and institutional product features lure capital. Why it matters for crypto investing: changing stablecoin flows affect liquidity corridors, lending markets, and where traders park capital. Shifts into yield products can change short-term funding dynamics and where margin support lives. Risk counterpoint: new yield stablecoins carry different counterparty and regulatory risks, and a run on any of them would be nastier than a hiccup for USDT, USDC. Diversification is not immunity. Flip to geopolitics. UK debates fate of 61,000 seized BTC worth $7.24 billion. UK officials are mulling whether to keep most of the 61,000 BTC seized in 2018, now worth roughly $7.24 billion, rather than return an equivalent current value to victims, setting up a potential legal and ethical brawl. Any government decision, sale, or protracted litigation could add meaningful sell pressure, or at least toxic headlines that spook markets. This is a multi-billion-dollar sovereign position that traders can't afford to ignore. Why it matters for crypto investing. A government-controlled BTC stash of this size is a potential macro supply overhang. Watch court filings, auction mechanics, and custodial movements for whipsaw risk. Risk counterpoint. Legal battles can take years, and sales might be dribbled out to minimize market impact. The mere existence of the coins is often more headline risk than immediate liquidity shock. Bank talk. Citi raises Bitcoin and Ethereum price forecasts. Citi updated its models and lifted targets. Bitcoin at $132,000 year-end and $181,000 in 12 months, and Ethereum at $4,500 year-end and $5,440 in 12 months. The bank cites ETF flows, institutional allocation, and Bitcoin's growing role as digital gold. Those headlines are easy clickbait for allocators and retail momentum players alike. Why it matters for crypto investing. Big bank price targets shift institutional sentiment, influence allocation desks, and give retail traders excuses to chase momentum, which can create transient feedback loops in price. Risk counterpoint. Price targets are models, not prophecy. Markets can ignore or punish overconfident forecasts, especially if real capital flows don't materialize. Finally, TradFi goes on-chain. FG Nexus and Securitize to tokenize common and dividend-paying preferred shares on Ethereum. Nasdaq-listed FG Nexus announced it will tokenize its common stock and a dividend-paying preferred share on Ethereum through Securitize, claiming identical legal rights and on-chain settlement via a regulated alternative trading system. This is one of the clearest moves yet to stitch recurring cash flows and listed equity rights directly onto an L1 ledger. If custody, legal wrappers, and settlement work as promised, tokenized equities could expand on-chain institutional activity in a meaningful way. Why it matters for crypto investing. Tokenized equities can broaden on-chain liquidity, enable new synthetic and carry trades, and create tighter cross-market arbitrage opportunities, valuable for traders focused on yield and settlement inefficiencies. Risk counterpoint. Regulatory scrutiny, custody complexities, and fragmentation of liquidity between traditional venues and on-chain ATSs could slow adoption and create unexpected settlement friction. If you like this rundown, smash subscribe and ring the bell so you don't miss the next market-moving weirdness. That's Today in Crypto, where the gains are imaginary and the pain is real.